What's going on, YouTube? In this video, we're going to talk about possibly the only solar company that isn't going to zero in the short term, and that is going to be First Solar, ticker symbol FSLR. And year to date, company is up 4% over the course of 1 year, down 3.5%, basically flat on the year. In comparison to the rest of the solar industry, this company is holding up very well. And once we dig into the financials and some of the earnings report, it's got good reason to be, and maybe this is a good buying opportunity for us on First Solar. As we dig in, we'll go through some numbers, the financial statement, and run this thing through a calculator, figure out what this thing is worth today after its most recent earnings report. They did report earnings October 31st. Missed on revenue, but beat on EPS, and we'll explain why and how they beat on EPS, but missed on revenues. So on their third quarter report, they have increased their sales backlog. I believe last quarter was like 71 gigawatts, and now they're at 81, almost 82. So they've got, if you do the math, on every 1 gigawatt they make, it's $300 million. So you can figure, do 300 times 82 basically, and that is roughly the revenue that is waiting for them. So in their net sales for third quarter were 801. It was a decrease of $10 million from the prior quarter. So obviously they missed on revenues, but also are slightly down from last quarter's revenues as well. So about $100 million roughly down from expectations. They were also able to pull off a positive EPS of $2.50, basically because of the IRA Act that they have. They had acquired those subsidies and have attributed them to the cost of goods sold. So they did see a slight decrease to their cash. So they got 3 plants. So the decrease was primarily offset because of the 3 plants that they are building in Alabama, Indiana, and Ohio. So the company also, in the meantime, is working on having higher conversion efficiencies on their solar panels. They're looking to take it from 25% to 35% energy capture. As the sun penetrates the panel, it captures about 25%, and they've got this new film that they're coming out that should potentially capture 35%. That's going to be probably some pricing power in the future for this company, because a lot of companies will then want to buy these panels that capture 35% instead of 25%, because they're going to have to buy a lot less of them and going to need a lot less room. So that is a pretty important thing to keep an eye on in this company, I think. So this company gets about 17 cents per watt for each module it produces in the United States. And depending on which module they get, you can probably average it at about 450 watts per module. I think their best module does like 480 watts. Their lowest one does like 430 or something like that, in that range. So you're looking at about 450 watts per module at 17 cents is about $82 roughly per module earned when they sell, and they sell a lot of modules per quarter. And during the third quarter, they recognized about $205 million of credits compared to 155 million in the second quarter. These credits then get attributed to their right here we can see they add them to their cost, or actually really deduct them from their cost of sales. So we're gonna hop over to their financials, and then right after this, we'll hop over their 10Q, their earnings release, and take a look at that as well. There's a few numbers to go over on that. So revenue, gross profit, net income, all three it's very messy. There's no real good consistency to it, no real trend higher or lower. It's just kind of bouncing all over the place. Same thing with net income. It's positive, it's negative, it's positive, it's negative. Not really good it's very difficult to forecast future pricing to value. Gross margins, though, because of this IRA Act, has almost doubled its margins, now sitting at about 47%. Net margins sitting at 33.5%. So margin increase substantially because of that IRA Act that is getting implemented now. And this is the last quarter numbers, by the way. So last quarter was 47%. Last quarter net margin was 33.5%. Return on invested capital on the company is sitting at about 6.2%. Currently sitting at 34 PE. Earnings yield only 2.9%. Cash to short-term debt. We have more cash than short-term debt, but we have more debt than cash. But we'll go over these numbers also on the earnings report. Net income to free cash flow. Company's got a lot of net income, but they have a lot of capital expenditures, and some of it they do have a small little breakdown of capital expenditures, but a lot of it is genuine capital expenditures. And so this company's got a lot of capex currently. Free cash flow then becomes a negative after you deduct out capex from your net income. You have a negative free cash flow, and they cannot turn positive free cash flow. They've done it twice so far in the last 10 years, or 9 years. So not a very good track record of free cash flow. Share count dilution, they are very slightly diluting shareholders. They've got a very small stock-based compensation payout. But other than that, they don't dilute shareholders by issuing common stock, and they are not buying back any shares at all right now. So over here on the 10Q for FSLR, we can see right here. So net sales, 800 million. Last year, 628 million. So good growth just on revenue year over year. This is 3 months, by the way. And so right here is where it starts to implement that IRA Act. So last year they did basically 608 cost of sales. This year only 425. So they did more revenue. Cost of sales went down. Basically, we know that it was $255 million of this IRA Act that's implemented into this price. So if you were to hypothetically add that back in, you're looking at about $680 million in cost of sales. But obviously this IRA Act is a thing. It's going to be a thing for the next, I believe, 4 to 6 years. I can't remember. It's 2030 or 2032, but it is a thing. And this will help this company's revenues this company's gross profit and net income going forward for many years to come now. But that gives them a gross profit then of $376 million. Right now might be a great time for them to ramp up their R&D, which they have a little bit. They have increased it by about $11 to $12 million. So could be good. Could be working on something more. Obviously, they came out that new film that they're going to hopefully implement soon, which will then harness an additional 10% in their panels. So one thing to note is that by 2025 to 2026, the company is building these 3 other plants. They're forecasting to produce about 25 gigawatts per year. And if they can maintain a 30 cents per watt sold, that is about $7.5 billion in revenues annually. And that's not including the IRA Act that they get, which is an additional 17 cents per sold in the US only, obviously, not everywhere. So just the US. So you figure 25 gigawatts, that's $7.5 billion in revenue. Currently, the company, if we come back over the financial spreadsheet, we can see the company is currently doing $3.2-ish billion in revenue. So you're going to more than double your revenue within the next 2 years. Assuming everything goes as planned, that is what we're looking at. And then on top of it, you get to deduct out even more of that IRA Act from your cost of revenue. So I think this company's got some pretty good tailwinds that come in. Down here on the balance sheet, this is where things get pretty decent. So we've got cash and cash equivalents. We've got $1.8 billion in cash. They have burned roughly $750 million in the last 9 months, potentially likely from those plants that they are building. Inventories are up slightly, so something to keep a close eye on. There's more inventories down here as well. So they got about, $1.4-ish billion in inventories, 1.04. We have about $1.72 billion in deferred revenues. So this is money, unearned revenue that the company has acquired. Obviously, it is a liability until they deliver the products, then it transfers over to revenues. So it's already prepaid for, but it's a liability because it has not yet been delivered. So what we can do is deduct out $1.72 billion in deferred revs. That leaves roughly $1.5 billion in total debt, and they have $1.8 billion in cash, which then tells me they've got a good, strong balance sheet because then they have more cash than total liabilities, not just short term, but total liabilities. So pretty good balance sheet overall. So over in the cash flows, this is where things kind of look a little ugly. So everything else has been pretty good. Cash flows aren't that great. So we've got net income of $481 million in the last 9 months. You get to add in a little bit of depreciation. Then there's some other changes throughout the balance sheet here, the cash flows here. There's a lot of changes, a lot of deductions coming out of our cash flows just from changes in operation or in assets and liabilities, which then leaves us with about $41 million in cash from operations in the last 9 months. And then on top of it, we've got $1 billion in capital expenditures. So basically, we're negative $1 billion 9 months time of CapEx. Hopefully, the company can kind of turn that thing around. Last year was $578 million. Still would put them negative, even if that's where it was at, but obviously not nearly as bad. So again, something to keep an eye on. Some of that could be slightly attributed to these plants that they are building. So we'll have to wait and see exactly what they're doing. They do have a slight breakdown of their capital expenditures. but they don't really give us any clear direction as to exactly. I mean, here's their breakdown. So construction in progress, we can cross out $1 billion in CapEx. But then we've also got land, which you got to pay for. You got buildings and improvements, that's part of it. Machinery and equipment. Okay, maybe they're buying machinery and equipment for these new buildings, so maybe we'll see that number tick down lower potentially. That's possible. Office and equipment furniture, we can see ticked up. So again, maybe with these new buildings, maybe we'll see that pull back as well. So maybe CapEx, once these buildings, these new plants get finished, maybe CapEx will throttle back and maybe we can start seeing some positive free cash flows out of the company. So we'll have to wait and see, keep an eye on the cash flows and see how things are trending overall in the coming quarters. So over on the comps, I have 4 other companies to compare to. There's not really necessarily a direct competitor to FSLR because FSLR, they sell mostly just to like commercial and industrialized companies. They don't really do too much with residential. FSLR is more of the commercial and industrial company. We do have a few red flags on the company. Profit margin telling us we're at 15%. Obviously, these are trailing 12 months numbers too. Return on equity and return on invested capital both below 15%. Operating cash flow is higher than net income, and share change slightly higher. So nothing too alarming. We have gone through a lot of those numbers already. Top down to the margins here, we've got a gross margin, operating margin, and profit margin, and we can see FSLR is the leader, and that's only going to get better because of that Inflation Reduction Act that is going on. And obviously we know these margins have already increased over the last quarter, so these are only going to get better in the near term future. Free cash flows, all of these companies are negative, so it might be a bit difficult to be positive free cash flow in the solar industry based on what we're seeing so far. Return on invested capital, again, this is what we have to compare to, and it looks like return on invested capital, we're right near the top. PE, because of how good these margins are on FSLR and the future of what this outlook looks on the company, you're going to pay a little bit of a premium for the company if you want to buy it today. Earnings yield sitting at 2.9%. Obviously, it looks like we can have a better earnings yield, and CSIQ has a pretty decent one. So over here on the calculator, Peter Lynch valuation, FSLR. Down here, we can see the 3-year average growth rate for the EPS was 66%. I changed that down to 20%. So, and you'll see why once we get to Rule 72. But with that change made, that gives us a Peter Lynch fair value of $88.20. Multiples comparison, we have 3 negative companies, so we're going to have to eliminate those. That leaves us with just 1, which gives us a price per share of $16.45. Manual PE, we have market cap minus cash, add in debt divided by cash from operations. It gives us about 21 years before we earn our current market cap, which tells us we're just slightly above undervalued. Price to book, 5-year average sitting at 2, currently at 2.5, slightly above their 5-year book average. PEG ratio sitting at about 1, and forward-looking PEG telling us we are very undervalued based on PEG ratio. Graham's valuation gives them $167.75 per share. So because they are negative discounted cash flow, we will eliminate that from our final valuation number. Rule 72. So here's our 3 sources of an EPS growth rate: Seeking Alpha 43, Yahoo Finance 6, and the 3-year that we got from our calculator spreadsheet is 66. So I then changed that to 20 because I feel like that's more of a more down-to-earth number. So it could be more, but you know what? I'd rather be low than high. So that averages out to 23% EPS growth rate, which I think is still pretty solid. That goes into 72 3 times, and that goes into 10 years 3 times. So then we get to double our EPS 3 times again. And that is 35 for a future EPS, which gives us a fair value today of $402.50. So over here at the final valuation on First Solar. So we're going to eliminate our DCF price because of the valuation on it, because they were negative free cash flow. That today gives us fair market value of $168.73. Currently trading basically $152. A 30% margin of safety on the company would be $118. And analysts have a price target of $230.74. So one thing we know is that in the last quarter, EPS was $2.50. So if you multiply that by 4, that gives you $10. So that's a pretty comfortable assumption because of what they've done. It wasn't anything out of the normal. The Inflation Reduction Act is what helped them get to that that 46-cent beat on their EPS. What we can do then is forecast, roughly a year in advance on this company and say, okay, our EPS then, let's say hypothetically, is going to be 10. So we can type 10 in for our EPS, and we'll maintain our growth rate on the EPS of 20% because we also know in the next, 2 years roughly, we're going to see a big growth in revenue because they're going to be producing more gigawatts per year. So we'll maintain our 20% growth rate on this particular situation. So our ticker EPS then in the next year will be about 10, right? And eventually, hopefully, they'll start being able to produce more gigawatts per year, and then that'll increase their revenue and then also increase their earnings per share. So if we leave everything else the same and we say, okay, 1 year from now, we add in 3 more quarters, that'll add up to 10 for future EPS. So that gives us a P/E fair value of $200. That changes our comparison to $37.30. That then gives us a PEG ratio of 0.49 today and 0.38 in the future. That gives us a grams valuation of $380 per share. Then we come down here, our DCF will not change, it'll maintain the same, neither will our discounted cash flow. But then we come over here to our final valuation, our fair market value. Now we're looking at $255.05 per share with a 30% margin of safety of $178.50 per share. Now that number there is very doable. Obviously, they're already kind of doing it. And obviously the forecasting within the company is like almost like guaranteed. They got signed contracts for 81 gigawatts of power, and they keep adding more gigawatts per year, almost per quarter for backlog orders. And then on top of it, you get the Inflation Reduction Act, which is helping out your bottom line tremendously because it's cutting off so much of your cost of goods sold. So in the next 4 years, this company's got quite the tailwinds going for it. And right now, just based on that one change of changing our EPS to 10, it gave us that much more of a higher fair market value on this company. That is something that is very, very likely to happen, and I would not be surprised to see this company maintain around $152 per share. I don't think it's going to trend much lower because, people are going to start pricing this stuff in. They're going to say like, okay, we've just got proof that here's what these numbers are going to do. Here's what our bottom line is going to be. Obviously, revenues aren't great right now, but they can always tick back up once more orders come in, and once they start getting a plant opened up, another plant, and then the third plant, they're going to start generating more gigawatts per year. So right now, based on the forecast and the numbers we just went over, I think a fair market value in this company is probably closer to $255 versus where it was. So over here on the stock chart for First Solar, we have a few trend lines drawn in here. Very simple. We like to keep it simple. We have support range around $118 per share, which is right where our 30% margin of safety is. So maybe we'll get lucky and see that number. But there is a little bit of some support right here. Looks like it's maintaining that support so far at about $142 per share. And right now we are locked in this massive downtrend. This is also on the weekly chart, but we are locked in this downtrend. Have not broken through yet. But as soon as you see a breakthrough, we're probably heading back up a little bit. But we'll have to wait and see how price action handles over the coming weeks. If we can see a downturn to this one, maybe it comes back down a couple, at least back down to maybe retest these lows here on this candlestick. If it does, that could warrant a pretty decent buying opportunity in this company because of the future outlook of this company with the Inflation Reduction Act associated to it and the potential growth on the company where they're in the process of building these plants. And they're telling us they're going to produce about 25 gigawatts of solar per year, which equates out to be about $7.5 billion, which is a double in their current revenue. So, there's a lot of positives in this company, and I think all the headwinds are behind it, and we've got nothing but tailwinds for this company right now. It'd be great to see this thing pull back a little bit more for us so we can start getting this thing for a better deal than where it is right now. But I think we might have potentially missed it on this last week's candle. If you want to buy it today, it could be a good place to buy. Although a better place to buy is to see if it does pull back a little bit in the next coming weeks to about $118 per share. But, we'll have to wait and see what happens with this one. That is it for this video, and we'll be back later with another stock analysis video.